Okay, now let's talk about learning objective 6, which is show how to speed up cash flow from receivable. So let's talk about. So, would you like to receive money from your account receivable early or a little bit late? Of course, early is better. So there are going to be like strategies in which you try to shorten this credit cycle. Number one is sales discount. We already talked about that, like 210 net 30, in which you encourage that rather to wait for 30 days. You can pay me in 10 days. I'm going to give you 2% discount, right? And then the second one is the interest on past due customer accounts, in which basically you charge some kind of like fees or penalty. If you didn't pay for you know if you didn't pay for more than 30 days, you will be charged for 2% extra amount or service fee, or the charges of not paying, or paying late payment penalties is like that. And then effective credit and collection procedures, you make it more easy to collect. You can offer, you can ask the customer to either deposit it to the bank. He has not necessarily has to come to the company and hand over the money. He can directly pay from his computer, or from his nearest ATM machine whatsoever. You can make effective collection procedure as well, or you can just send your own person who can collect on your behalf. There are some agencies or securities agencies or collectible agencies who do this kind of stuff as well. And from the recent years, as electronic banking has become more popular, a common strategy that is using nowadays is the emphasis credit card and bank card sales, in which you don't have to worry about that. Even if you have a credit card, you will be given the goods at spot, and the customer, they get 1% or 2% discount by using credit card as well. So it means, why the customer is giving 2% on, or 1% on credit card? Because you are essentially making your credit period to zero, from 30 to 0, right? So you offer them 2% discount. So these are the effective strategies to shorten the account receivable cash flow cycle. So what if you have a credit card and bank card sales? So we have an illustration here. Let's talk about that. So Apple Incorporation sells a computer and peripherals devices worth of 5,000 at one of its stores. A customer pays via Visa card. Visa card charges company 2% processing fees. So card fees, how much 2% is? $100. So what if the company charges from you 2% fees? The entry would be, you receive cash 5,000? No, you receive cash 4,900. Why? Because that transaction go to the bank account, then bank take 100 as a charges. So but you have a sales of 5,000, right? Sale gonna be 5,000, but and that is an expense. When expense rises, it's debited. This is going to be bank charges or credit card charges or credit card discount charges, whatever you want to write, it is okay, right? This is how you calculate the credit card or bank card sales. So another way to shorten the account receivable is the use of factoring, or which is called them selling the account receivable. So what if you have a balance sheet? You have current assets, and the current assets you have account receivable. What you actually sell it to a third party, and you receive cash, right? We call this factoring or selling of the account receivable. So company sells its receivable to some factor, to a factor, for example 95. It means if you have 100 in your account receivable, 95 you receive it, and the person who actually buy your receivable, it's his effort, right, in which you sell your account receivable on some kind of discount price, right? So it benefits with immediate receipt of cash, right? If you want to immediate, cash receive, you can just sell your account receivables to a factor and you receive the cash, immediate cash. You can use it to your, funding purposes or whatsoever. So you can have, why the company they sell their account receivable. Number one, who has a weak or insufficient credit history or significant amount of debt. If you buy raw materials, too frequently on credit and you want to pay them, and time is overdue, and the suppliers demand money from you, one motive is that you factor your account receivable and you receive cash, you pay to write off your duties, pay off your duties, to pay cash to others, right? Number two, if you have, if collecting cash from customer is very expensive from you, or you have lost control over your collection process. For example, you have to make calls to your account receivable for reminders, right? The telephone bill is so high, you need an extra person to watch over this account, payable receipts and all those stuff. It's very costly for you, so it's better you go for factoring, right? And you sell your account receivable. So how to account for this sell? So we have an example here. Suppose a company wish to speed up cash flow and therefore sells 100,000 accounts receivable. Receiving cash 95,000, the company would record the sales of the receivable as follows. So you sell your receivable and you receive cash. So cash to financing expense is going to be like 5,000, which is your expense, right? The difference between factoring expense, and you sell your accounts receivable. So it means collecting from your accounts receivable is not your responsibility now, it is the responsibility of financing agent, which is called factor, right? And that is his income and it is your expense. Here we go, we have successfully answering our all learning objective statements. So I will be uploading our assignment 5 on our WeChat group or on also on Blackboard. Please respect the due date and follow the instructions. Okay, thank you for listening to the whole lecture. Next time we're going to meet with an exciting new chapter. Until then, see you, take care, bye bye.